DBS says despite the global disruptions from trade tensions, Asia's biggest economy and the main target of US President Trump's tariffs, that is China, still promises plenty of growth potential. Tan Su-shan, who succeeded Piyush Gupta as CEO last month, took up the conversation with CNA's Elizabeth Neo.
You know, China, for example, is in a much better position, to deal with Trump 2.2 than it was dealing with Trump 1.0.
Tariffs are here to stay. It's just a matter of how high. And I think China, through Trump 1.0, has already learned to insulate itself. They've become more resilient, both in their own supply chains, their food security, their semiconductor chip security, their energy security. Whilst this is a bit of a blow both for consumer confidence, I see the country really sort of rallying behind this need to be resilient, and so I see that the country will continue to invest in what will keep them relevant in the future. That means investing in future-forward technologies, be it humanoid robots, be it drone technology, be it DeepSeek like generative AI, deep tech, biotech. So there are certain future growth pathways that I think are coming out of China that they are investing in. They've already done extremely well in the EV construct. They've done very well in EV supplies and battery storage. They are already investing big time in renewable green power. In fact, what China has invested in the last year was more than the rest of the world combined. So I think there's been concerted effort to really make China self-sufficient in energy and semiconductor chips and in tech and in food. And with that will come opportunities. One, hopefully a bottoming out of consumer confidence that can be engineered if we see the stock markets being supported and more upside potential, hopefully. Already in our wealth flows in Greater China, we are seeing more wealth flows in Hong Kong and China, and that's good. That speaks to, and if the markets continue to do well, then that consumer confidence can spill over to the wider, to Main Street from the stock market. Lower interest rates have been going down in China, and lower rates will be helpful for the property market. They are already trying to unlock some of the opportunities for purchasing of homes and helping with mortgage growth, etc. So it might trundle along and it could be a little bit slow, but I think longer term, the China growth prospects are still going to be there. Whether it's 4 or 5%, who knows? But you can see the focus on growing, deep tech and future industries, and I think the self-sufficiency is going to get stronger. China plus one, China investing into Southeast Asia, into ASEAN, into the global south, that trend will continue. I'm constructive as to that sort of bilateral trade talks and more co-investments, mutual help will continue. And as I said, the green energy, the green tech coming out of China, and frankly, ASEAN has a lot of green renewable power as well. And I think, like, for example, Indonesia, Malaysia, there's a lot of green resources to harness. The grids need to be built. So there's a lot of investment needs for Asia and China there. And I think that's where we stand to benefit.